Welcome everyone. Today we are going to talk about a very important topic. It's a question that many people ask themselves. Where is the best place to put my money so it can grow? This is a fundamental question for anyone looking to build wealth for the future, for retirement, a down payment on a house, or creating a more secure future for your family. The world of investing can seem very complex and intimidating at first glance. There are so many options available to you: stocks, bonds, real estate. Two of the most common choices for everyday investors are buying individual stocks or investing in index funds. You might hear stories about people who made a fortune by picking the right stock at the right time. On the other hand, you might also hear financial experts talk about a simpler, more steady approach using index funds. So which path is the right one for you? In this video, we will break down this big question into simple, easy-to-understand parts. We will explore exactly what stocks and index funds are. We will look at the pros and cons of each approach in great detail. By the end of our discussion, you will have a much better understanding of this classic investment dilemma. So let's get started on this important journey together. Let's talk about the allure of picking individual stocks. It's a powerful and exciting idea. You see the headlines. A small company suddenly becomes a giant. Its stock price soars. This dream is fueled by legendary investors like Warren Buffett, who built fortunes by carefully selecting companies. When you buy a stock, you're acquiring a small, fractional piece of that business. You become a shareholder. If the business you've invested in does well and becomes more valuable, the value of your ownership stake, your stock, should also increase. Owning individual stocks puts you in the driver's seat. You have complete freedom to build a portfolio that aligns with your beliefs. If you're passionate about environmental issues, you can invest only in companies you believe are making a positive impact while avoiding others. This control also gives you tactical flexibility. You can buy more of a great company when its price falls, or take profits when you feel it's overvalued. And this is the grand prize: the potential for truly extraordinary returns, far exceeding what an index fund could ever deliver. However, this dream often clashes with a much harsher reality. For every success story, there are countless untold stories of failure. Many stocks stagnate or lose all their value. Picking winners consistently is incredibly difficult. It requires a serious commitment to doing your own homework. The emotional roller coaster can be stressful, leading to impulsive decisions that wreck long-term financial plans. And the biggest risk? A single unforeseen event can wipe out your entire investment in that one company. Now let's turn to index funds. If picking stocks is like searching for a needle in a haystack, investing in an index fund is like buying the entire haystack. An index fund holds a portfolio of stocks that mirrors a specific market index, like the S&P 500, which represents the 500 largest companies in the US. When you buy an S&P 500 index fund, you instantly become a part owner of hundreds of businesses across various industries. This built-in diversification automatically reduces your risk. If one company performs poorly, its impact is minimized because many others are likely doing well. This leads to a massive advantage: very low costs. Actively managed funds charge high fees for their expertise, which eat into your returns. Index funds are passive. They're run by computers that simply follow the index, so their operating costs are incredibly low. Over a lifetime of investing, these lower fees can add up to tens or even hundreds of thousands of dollars in extra returns for you. This strategy is simple. You buy the fund and hold it for the long term, freeing you from the stress and complexity of the market. But index funds aren't perfect. When you buy the haystack, you get everything in it, including the bad apples. You give up the potential for extraordinary returns. An index fund is designed to deliver the average return. It will never dramatically outperform the market. And diversification offers no protection when the entire market falls. In a bear market, your index fund will fall right along with it. So, when deciding, the most important factor is your personality. Are you a pilot or a passenger? Pilots want control. They enjoy the research, the analysis, and are willing to take higher risks for the chance of higher rewards. Passengers prefer a simpler, hands-off approach. Their goal is to arrive at their destination safely and efficiently, without having to fly the plane themselves. For the overwhelming majority of people, the evidence is clear. The humble, low-cost index fund is the more prudent and, ultimately, more successful choice for achieving your financial dreams. Building wealth is a marathon, not a sprint. Start early, invest regularly, keep costs low, and maintain a long-term perspective. Thank you for joining me today. If you found this video helpful, please subscribe, like, and share it with a friend.